Dear students, I'm thrilled to have each of you here today, joining us on this journey toward mastering the essentials of financial accounting. You've taken an incredible step forward in your studies, and I couldn't be prouder of your dedication and commitment to growing your knowledge. Today, we're diving into the 6th lesson from the FIA FA1 chapter, where we'll explore different types of discounts, rebates, and allowances. This lesson is all about understanding the various ways businesses incentivize transactions, from offering bulk purchase discounts to providing rebates for loyal customers. It's an essential topic, packed with practical insights that will truly empower your understanding of financial transactions and business strategies. As we go through today's lesson, please remember that your support means the world to us. If you find value in our content, please like this video and subscribe to the channel so we can keep bringing you the best study materials and guidance on your path to success. Let's get started and make today's lesson amazing. Let's dive deeply into discounts, rebates, and allowances and explore how they work in business transactions. Discounts, rebates, and allowances are all ways in which sellers adjust the prices of goods or services. Specifically, we'll focus on two common types of discounts: trade discounts and cash settlement discounts. Each of these serves a different purpose, is applied at a different time, and has its own conditions. What is a discount? A discount is simply a reduction in the price of goods or services. It's a way for sellers to adjust prices, often to encourage more purchases or faster payment. When a discount is offered, the buyer pays less than the standard price that other customers might pay. Types of discounts. 1. Trade discount. A trade discount is a price reduction that is usually offered for reasons related to the business relationship or type of transaction. It's given directly on the supplier's invoice, meaning that the reduced price is calculated before the buyer receives the invoice. This type of discount is most commonly offered in two main scenarios. Buying in bulk. When a customer buys a large quantity of goods, the supplier might offer a trade discount to incentivize this larger purchase. For example, if an item usually costs $1 per unit, the supplier might reduce the price to 95 cents per unit if the customer orders at least 100 units at once. The supplier benefits by selling more at once, and the customer benefits from a lower unit price. Loyal or regular customers. Some businesses reward frequent or valuable customers with trade discounts as a way of recognizing their loyalty. Even if each individual order isn't large, the customer might receive a trade discount on every purchase because their overall spending with the supplier is significant. This type of discount can be a reward for long-term commitment or high cumulative purchases over time. Given on the invoice. The trade discount is shown directly on the invoice, reducing the price the customer is charged. Permanent reduction. Once it's offered, the trade discount doesn't depend on how quickly the customer pays. It's simply a price reduction based on the transaction type or relationship with the supplier. Example. Imagine a retailer purchasing office supplies. If they usually pay $50 per box of paper, the supplier might offer a trade discount that reduces the price to $45 per box if the retailer orders 50 boxes at once. This motivates the retailer to buy in larger quantities. 2. Cash settlement discount. A cash discount, also called a settlement discount, is offered to encourage the buyer to pay promptly. It's not based on the quantity of goods purchased or on being a loyal customer, but rather on how quickly the payment is made. Suppliers may offer a cash discount to improve their cash flow by receiving money sooner rather than later. How cash discounts work. Immediate or early payment. The discount is given if the buyer pays immediately or within a specified short period. The supplier sets specific terms indicating the discount percentage and the payment deadlines. Conditions for the discount. If the buyer doesn't pay within the time specified, the discount is no longer available. This means that the discount is withdrawn if payment isn't received on time. Example of cash discount terms. Suppose a supplier charges $1,000 for goods and offers a cash discount with these terms. 10% discount for immediate payment, meaning payment on the day of the invoice. 5% discount if payment is made within 7 days of the invoice date. No discount if paid after 30 days. Instead, the full amount is due within 30 days. If the buyer pays on the day of the invoice, they would only need to pay $900, benefiting from the 10% discount. If they pay within 7 days, they would pay $950 using the 5% discount. However, if they wait longer than 7 days, they would pay the full $1,000 because the discount terms have expired. Characteristics of a cash discount. Encourages prompt payment. It's a short-term discount meant to incentivize early payment. Removed if late. The discount disappears if payment isn't made within the specified time frame. Why is the difference between trade and cash discounts important? The distinction between trade and cash discounts is crucial because these two types of discounts are accounted for differently in financial records. Trade discounts. Since trade discounts are applied directly to the invoice, they reduce the sales amount up front. The buyer pays the discounted price from the beginning, so the original price doesn't even appear in the books. This discount is considered a straightforward reduction in the cost of goods. Cash discounts. Cash discounts are recorded as a separate financial transaction because they only apply when payment is made within a specific time. If the buyer misses the deadline, they pay the full amount, so the discount isn't guaranteed. When it is used, the cash discount is often recorded as a financial expense or reduction in income for the seller, reflecting the seller's intention to receive early payment. Key takeaway. Trade and cash discounts serve different purposes and are applied differently. Trade discounts are incentives based on the size or type of the order or customer loyalty and are permanent price reductions. Cash discounts, on the other hand, are rewards for prompt payment and are only available temporarily. Setting the scene. Ginger Spice and her 3 suppliers. Ginger Spice, a businesswoman, buys goods from 3 suppliers: Scary, Posh, and Sporty. Each of these suppliers offers discounts, but the discounts work in different ways. These discounts are either trade discounts, given for being a loyal customer or buying in bulk, or cash, or settlement discounts, given for paying quickly. Let's go through what each supplier offers. 1. Scary's discount. Scary provides Ginger with a trade discount. This discount is simple. Ginger gets a reduction in the cost of goods whenever she buys from Scary. Specifically, Scary offers a trade discount of 5% off Ginger's purchases. This discount is applied directly to her invoice, and it's a permanent reduction in price, which means it doesn't depend on when Ginger pays. She gets 5% off automatically as a customer, regardless of payment timing. 2. Posh's discount. Posh also provides a trade discount, but it's a bit more complex. The discount Posh offers only applies to amounts spent over a certain threshold. Specifically, Posh's discount is 7%, but this only applies to the amount over $100. So, if Ginger spends more than $100, only the portion above that amount receives a 7% discount. This type of discount encourages Ginger to spend a little extra because it only kicks in on the amount she spends beyond $100. 3. Sporty's discount. Sporty, the 3rd supplier, takes a different approach and offers cash or settlement discounts. These are based on how quickly Ginger pays. Sporty provides 2 options. If Ginger pays immediately, right when she makes the purchase, she gets a 10% discount. If she can't pay immediately but pays within 30 days, Sporty still offers a discount, but at a reduced rate of 5%. So, the faster Ginger pays, the larger the discount she receives. This approach encourages her to pay quickly, either on the spot or within a short time frame. Ginger's purchases in January. In January, Ginger buys goods from each of her suppliers, and she makes sure to understand the specific terms for each discount. 1. Purchase from Scary. Ginger purchases goods worth $400 from Scary. Since Scary's discount is a simple trade discount, Ginger automatically receives a 5% reduction on her total purchase amount. To calculate the discount, we take 5% of $400. So, $400 multiplied by 5% equals $20. This means Ginger saves $20 on her purchase from Scary due to the trade discount. 2. Purchase from Posh. Ginger also makes a purchase from Posh worth $700. Posh's discount only applies to amounts over $100, so the first $100 is not discounted. However, the remaining $600, $700 minus $100, qualifies for the 7% trade discount. To calculate the discount, we apply 7% to $600. $600 multiplied by 7% equals $42. Therefore, Ginger receives a $42 discount from Posh. Number 3. Purchases from Sporty. Ginger makes 2 separate purchases from Sporty. Let's go over each one. First purchase. For her first purchase, she spends $350 and pays immediately in cash. Because she paid right on the spot, Sporty applies the full 10% cash discount. To find the discount, we calculate 10% of $350. $350 multiplied by 10% equals $35. So Ginger saves $35 on this purchase because she paid immediately. Second purchase. Ginger's second purchase from Sporty is worth $700, but she doesn't pay immediately. Instead, she plans to pay within 14 days, which qualifies her for the 5% cash discount since it's within the 30-day period but not immediate. For this discount, we calculate 5% of $700. $700 multiplied by 5% equals $35. This means Ginger saves another $35 on this purchase due to the prompt payment. Adding up Ginger's total discounts. Now that we've reviewed each purchase and calculated each discount, let's summarize Ginger's total savings for January. 1. From Scary. Ginger saved $20 from the trade discount. 2. From Posh. Ginger saved $42 from the trade discount on the amount over $100. 3. From Sporty. Ginger saved $35 on her immediate payment and another $35 on her prompt payment within 30 days. To find the total amount Ginger saved, we add up all these discounts. $20 plus $42 plus $35 plus $35 equals $132. Summary of types of discounts received. To wrap up, Ginger received 2 main types of discounts. Trade discounts. These are the permanent price reductions she received from both Scary and Posh. Scary applied a straightforward 5% trade discount on her entire purchase, while Posh offered a 7% discount on the portion of her purchase over $100. Cash discounts. These are the discounts she received from Sporty for paying quickly. By paying immediately for one purchase, she received the maximum 10% discount. For her other purchase, she received a smaller 5% discount because she paid within 30 days, but not immediately. In total, Ginger's efforts to understand and use each supplier's discount terms helped her save $132 in January. This example demonstrates how understanding discount types can be beneficial for any business owner. 6.3. Accounting for trade discounts. A trade discount is a straightforward reduction in the price that a customer is required to pay for goods. This type of discount is typically offered to incentivize bulk purchases, encourage loyalty, or recognize a special business relationship. In essence, it's a permanent reduction in price and is applied directly on the invoice. How trade discounts work for the buyer and the seller. 1. When a business receives a trade discount. Imagine a business purchasing goods from a supplier who offers a trade discount. The amount the business is required to pay will be the normal price minus the discount. This means the supplier provides a price that already accounts for the trade discount, making it lower than the standard selling price. For example, If a business buys products worth $1,000 but receives a 10% trade discount, they would only be billed for $900. 2. When a business grants a trade discount, if a business sells goods to a customer and offers a trade discount, it reduces the amount they demand from the customer right on the invoice. The customer, therefore, only pays the discounted price. For instance, if a business sells goods worth $500 but provides a 5% trade discount, the customer would only be billed $475. Number 3. Calculating sales tax with trade discounts. If the sale is subject to sales tax, the tax amount is calculated on the discounted price. This means that the trade discount is deducted first, and only then is sales tax applied to the reduced price. For instance, if goods worth $1,000 are sold with a 10% trade discount and a sales tax of 5%, the discount would first reduce the price to $900. The 5% sales tax would then be calculated on this $900. 6.4. Accounting for cash discounts. A cash discount, also known as a settlement discount, is different from a trade discount because it is optional. It's offered to encourage quicker payments from customers and is based on financing policy, not regular sales or trading terms. Cash discounts received. When a business has the option to take advantage of a cash discount from a supplier, it's making a financing decision. The choice here is whether to pay sooner to receive a discount or to hold on to its cash for other uses and pay the full amount later. Example. Suppose Company A purchases goods from Company B with a standard 30-day credit period. The invoice amount for the goods is $2,000. However, Company B offers a 4% cash discount for immediate payment. Company A now has two choices. Option 1. Hold on to the $2,000 for the full 30 days and then pay the entire amount. Option 2. Pay the invoice amount minus the 4% discount immediately. This means Company A would only pay $1,920 if it chooses to pay right away. Here, Company A needs to decide whether it's worthwhile to save $80 by paying early or if it's better to use the $2,000 for other purposes over the 30-day credit period. This decision is about managing finances efficiently rather than obtaining goods at a reduced price. Cash discounts allowed. When a business offers cash discounts to its customers, it's also making a financing decision rather than a trading decision. Allowing cash discounts means giving customers the option to pay less if they pay sooner. The reasons a business might offer a cash discount include: 1. Early cash flow benefits. Receiving cash sooner can provide financial flexibility. For example, having cash on hand might allow the business to earn interest on it or reinvest it elsewhere. 2. Financial security. If the business is facing cash flow difficulties or wants to avoid potential bank charges or overdraft interest, getting some cash now, though it's less than the full amount, can help stabilize finances. 3. Customer's financial reliability. If the customer's financial health seems uncertain, accepting a smaller amount immediately might be safer than waiting for the full amount later, as it reduces the risk of the customer defaulting on the payment. In summary, cash discounts are a strategic financial choice rather than a sales tactic. They allow businesses to encourage quicker payments, which can enhance cash flow and reduce financial risk, depending on the business's priorities and the customer's payment reliability. This approach offers a structured view of how trade and cash discounts are applied in accounting. Trade discounts are straightforward, fixed reductions applied directly to invoice amounts, while cash discounts are conditional on early payment and depend on the financial preferences and priorities of both the seller and the buyer. Analysis of the question. The question is about calculating the total amount PayQuick, a company, needs to pay for goods after applying two types of discounts, a trade discount and a cash discount. Here's what we know from the question. 1. List price. The original price of the goods is $22,000. 2. Discounts offered. trade discount of 10% on the list price. A trade discount is usually given to businesses to encourage bulk purchases or reward loyal customers. Cash discount of 2.5%, 2.5% if payment is made within 20 days. This discount is an incentive for quick payment, helping the seller improve cash flow. 3. Tasks. Task A. Calculate how much PayQuick will pay if it does not pay within 20 days, and thus misses the cash discount. Task B. Calculate the amount PayQuick will pay if it does pay within 20 days and qualifies for both the trade and cash discounts. 4. Note, we are instructed to ignore sales tax in these calculations, which simplifies the problem by focusing solely on the discounts. Step-by-step explanation of the answer. Let's go through each part of the answer carefully to understand how these discounts apply and how the final amounts are calculated. Initial calculation. Applying the trade discount. The trade discount is the first discount to be applied to the list price. This discount is calculated as a percentage of the list price, $22,000, and is deducted to determine a reduced price. Step 1. Calculate 10% of the list price. Trade discount equals text list price times 10% equals $22,000 times 0.1 equals $2,200. Step 2. Subtract the trade discount from the list price to get the price after trade discount. Price after trade discount equals list price minus text trade discount equals $22,000 minus $2,200 equals $19,800. At this point, after applying the trade discount only, the amount PayQuick would need to pay is $19,800. Task. Amount payable if payment is made after 20 days. If PayQuick pays after 20 days, it does not qualify for the cash discount. This means the company will only benefit from the trade discount and no further reductions are applied. Amount payable in this case. Total amount payable equals price after trade discount equals $19,800. So, if PayQuick delays payment beyond 20 days, it will pay $19,800. Task B. Amount payable if payment is made within 20 days. If PayQuick makes the payment within 20 days, it qualifies for the cash discount. The cash discount of 2.5% is then applied to the price after trade discount, $19,800. Step 1. Calculate 2.5% of the price after trade discount. Cash discount. Price after trade discount times 2.5% equals $495. Step 2. Subtract the cash discount from the price after trade discount to get the final amount payable. $19,800 minus $495 equals $19,305. Therefore, if PayQuick pays within the specified 20-day period, it will pay a reduced amount of $19,305, benefiting from both the trade discount and the cash discount. Summary of the solution. Without the cash discount, if payment is made after 20 days, PayQuick pays $19,800. With both discounts, if payment is made within 20 days, PayQuick pays $19,305. Important points to remember. Order of discount application. The trade discount is applied first to the list price, and then the cash discount is calculated based on the price after the trade discount. Cash flow implications. By paying within the discount period, PayQuick not only benefits from a lower price, but also helps the supplier's cash flow, which is often the reason sellers offer cash discounts. By breaking down each step and understanding the sequence of discount applications, we can see how each type of discount impacts the final amount that PayQuick needs to pay. Understanding other types of discounts. Rebates and allowances. In addition to trade and cash discounts, businesses may be offered other forms of discounts as incentives to encourage bulk purchases, loyalty, or to prevent them from buying from competitors. These discounts, commonly known as rebates and allowances, provide unique benefits that differ from traditional price reductions. They are strategically used to improve customer loyalty and volume of sales, rather than to directly impact the immediate cash transaction. Here, we'll explore how rebates and allowances work, their purpose, and offer clear examples to make these concepts easier to understand. Rebates, encouraging long-term spending. A rebate is essentially a form of post-purchase discount where a business receives a refund or partial repayment after purchasing a certain amount of goods or reaching a specific usage level. Unlike trade discounts, which reduce the upfront cost, rebates are given after the purchase is complete and usually after certain conditions are met. The goal of a rebate is to encourage long-term spending or usage by making it financially rewarding for the buyer. Key features of rebates. 1. Conditional. Rebates are usually contingent upon meeting a certain target, such as a minimum spending amount or usage level. 2. Delayed benefit. Unlike upfront discounts, the financial benefit of a rebate is realized only after the condition is met, often at the end of a specific period. 3. Flexible forms. Rebates can be given as a reduction in future costs or as a cash payout. Example of a rebate. Utility company rebate. Imagine a gas company offering a rebate to incentivize customers to use more gas. If a customer consumes over a specified number of units within a year, they qualify for a rebate. This rebate could be provided in one of two ways. 1. Reduced future bills. For the following year, the customer's monthly gas bills might be reduced by a certain amount, rewarding them for their higher usage. 2. Direct cash payment. Alternatively, the gas company may issue a check or direct deposit for the rebate amount, essentially returning a portion of the customer's spending as a reward. In this example, the rebate serves as a loyalty reward by reducing future costs or providing a financial refund, encouraging customers to continue using the company's services or products. Rebates are commonly used in utilities, manufacturing, and even consumer electronics, where buyers can receive a rebate if they purchase multiple units or exceed a specific amount of use. Allowances. Rewarding bulk purchases with extra goods. An allowance is another type of incentive discount, but functions differently than a rebate. Allowances are typically provided as additional units or products for free when a buyer purchases a specified quantity. They don't alter the price of each unit, but instead reward the buyer with extra goods, which increases the value of the purchase. Unlike rebates, allowances are given at the time of sale rather than at a later date, making them an immediate incentive for buyers to make larger purchases. Key features of allowances. 1. Immediate benefit. Allowances provide extra goods or units at the time of sale, increasing the quantity received without an additional cost. 2. Volume-based. Allowances are typically only offered for bulk orders, encouraging buyers to purchase more than they may initially need. 3. No impact on cash price. Since the buyer pays the same total price but receives more products, the allowance doesn't affect the total cash amount, but rather improves the per unit value. Example of an allowance. Retail allowance in a record shop. Suppose a record shop orders 50 compact discs, CDs, from a supplier. To encourage large orders, the supplier offers an allowance. If the shop orders 50 CDs, they will receive 5 additional CDs for free. So instead of receiving 50 CDs for the regular price, the shop receives 55 CDs for the same price as 50. In this scenario, the record shop gets more value for the same amount of money. Allowances are popular in industries where per-unit costs are low, and extra units can be easily given, such as in retail, food and beverage, and wholesale supply. Why rebates and allowances are used. Both rebates and allowances are commonly used marketing tools that offer indirect price incentives. Here's why companies might prefer these over traditional price reductions. 1. Encouraging larger orders. By offering an allowance, businesses incentivize customers to order in bulk. This can help companies achieve higher sales volumes and improve inventory turnover. 2. Building customer loyalty. Rebates encourage repeat purchases or long-term usage, making customers more likely to stick with a company over competitors. Since the benefit is often delayed, customers are incentivized to continue purchasing or using the product to qualify for the rebate. 3. Cash flow management. Rebates, since they are only provided after conditions are met, help suppliers maintain their cash flow while still offering financial incentives. Allowances, on the other hand, don't directly impact the cash price, making them beneficial for sellers who want to avoid immediate cash discounts. 4. Strategic cost management. Rebates and allowances don't reduce the immediate cash price, which means they can be applied without affecting the baseline unit cost. This can be useful for accounting purposes and allows businesses to maintain consistent pricing while still rewarding high volume or long-term buyers. Summary of key differences between trade discounts, rebates, and allowances. 1. Trade discounts. Direct upfront reduction on the sales price, applied on the invoice immediately. Commonly used for bulk orders or specific customer segments. 2. Rebates. Post-purchase discount applied after certain conditions are met. Offered as a future bill reduction or a cash payout, used to encourage long-term spending or usage. 3. Allowances. Extra goods provided free of charge when a specific quantity is purchased. Immediate benefit to the buyer, but does not affect cash flow directly, encourages bulk purchasing, and increases perceived value. By understanding these distinctions, businesses can decide when to offer trade discounts, rebates, or allowances depending on their goals, whether they aim to boost immediate sales, encourage larger orders, or foster long-term customer loyalty.